Hi, my name is Dhanya Shankar, and I'm reading this book for the author as a volunteer, and I grant permission for this tape to be used by him for his personal or commercial use. Preface. Dear reader, last year in 2020, when I published my book, Conversation with Mr. Sensix, I realized that it lacked something. Although I was completely satisfied with its structure and its content, I felt that it expressed many of my thoughts in vague forms. In that work, I had also refrained myself from giving real-life examples which had its own strength, since it allowed me to express complex topics in metaphorical ways which some readers felt as complex and unclear. That was its disadvantage. So, I was waiting for a new concept, a new idea to revise my thoughts about investing in the stock market and re-enter with a book that could help other retail investors in their journey. I also didn't want to write unnecessary chatter which would only act as an orgasm of inspiration, but something which truly contributed to the subject, something which was verifiable and new that would give a new sight to the learner. And it came. One day, I was sitting on our terrace pondering about the stocks I had made investment in or had researched about. I realized that there was a pattern which kept repeating. I penned these patterns in a book which eventually became the chapters and the kinds of multibaggers as you see today. I also wanted to write a book which I myself would prefer to read if I go back in the past when I began. That is what Common Sense and Multibaggers is all about. A book which any person without a financial background could read and understand no matter what his age is, as long as he can read and write. Author name Kalpesh Suryavanshi. Date 11th of May 2021. Chapter 1. Concept of Multibaggers. Quote, a significant difference between an investor and a non-investor is that the former understands inflation and its consequences. Unquote, by Kalpesh Suryavanshi. Multibaggers are like true love. You realize it when it is already too late. But unlike love, multibaggers are not limited. There is no age at which to discover multibaggers. They of course are rare, but possibility of finding them is equal for all of us. We just need the right lens to see, which this book aims to achieve. Traditionally, multibaggers are stocks that give you multiple times return on your investment. So, if a stock doubles your money, then it is called a two-bagger. If it multiplies your investment by 10 times, then it is 10 baggers. And if it turns your principal 100 times, then we call it a 100-bagger. Now, there is some limitation to this traditional definition of stock as it fails to consider the time taken by the stock to become a multibagger as well as the cost of stock to become a multibagger. While the fact is that time alone is what assigns value to our investment, and ignoring the time itself causes discrepancy in our definition. You see, stock A might take 1 year to double your money, while stock B might take 5 years, yet we refer to them as multibaggers, knowing the fact that one was quicker in its approach while the other slower. Therefore, it is necessary to change this definition so as to reflect equal clarity about both time and the cost which generated such exceptional returns. We are no more in the 19th or 20th century. The world has changed significantly in the past decade alone. And with the pace of internet and technology, it is expected to be faster in the future as well. But when it comes to our teaching and learning curriculum, it is still the same as it was a century ago. Of course, we have changed the medium through which we teach, like we use the internet, videos and projectors, etc., but the content has remained the same. Our books outwardly are designed differently, but what is within is still the same. And the effect of all these is seen in the investment world also. We are still using the old wisdom in our modern times. We are still dragging the previous definitions to this era, which is unsuitable, and thus we need to revolutionize the way we see, hear, and perceive things. Keeping up with the word, I shall then classify the multibaggers in various types according to their kind, pattern, behavior, and time at which they are conceived. In the upcoming chapters, we shall see various kinds of multibaggers and the ways in which they manifest, which will help you understand and identify them in a better way. Now, one may ask, why the need to classify? Why the need to redefine? The answer lies in your question itself. We update things because they are not suitable for the current situation anymore. Besides, the classification and definition of patterns is necessary, which shall serve as an identity, a mark for you to recognize them based on their type and kind. Now, how can you find something of which you have no idea about? See, you already know the traditional definition of multibagger, but what help does that definition provide you? The traditional definition is itself designed in a way that it reflects the past. It tells you when a stock becomes a multibagger, call it 10, 50 or 100 bagger. But this definition tells you nothing about how it became a multibagger or how much time it took to become a multibagger. Besides, it tells you nothing on how to identify one by your own. Imagine if I told you to find a pen in a room full of pens, which writes, then what pen would you give me? The room is full with pens, numerous of various inks, shapes, and sizes. Therefore, my information, my definition of pen to you is incomplete. Such is the case with the current definition of multibaggers. They lack preciseness, which a beginner needs. A beginner needs clarity of thought so he can learn and practice fishing multibaggers for himself. And, if not catch one, but at least recognize them beforehand with the signs we have given. My sole aim through this book is to give you that vision which shall help you to identify multibaggers with mere use of your common sense, which is quite uncommon these days. Chapter 2. Multibaggers Redefined. Quote, lucky enough to have discovered your passion, invest in it even if it costs your life. Unquote, by Kalpesh Suryavanshi. The world today is changing rapidly, and so is our market. The rise of cheap internet and conditions like the current pandemic of COVID-19, work from home, has become a new norm. Also, the rise of social media, blogs, YouTube channels have brought an interest in investing for the average, which has given birth to the idea that money is not only a means to buy but also to invest. It is like all the right things are happening at the right time, which in a market we call the period of boom. Introduction of discount broking firms have given birth to a generation of new kinds of traders. We can buy and sell our stocks faster than the blink of our eyes. The softwares and algos, which were once only the tools of the hedge funds, are now available to the common man. Investing in stocks is a new trend which perhaps has just begun and is expected to continue for the decade or even more. This, all in totality, has changed the structure of the market. Stocks, which once rarely had any volume, are seen as top gainers on the bourses. Small caps and mid caps have both overperformed the blue chips and the broader market as a whole. Also, the market today appears comparatively more volatile because of the conditions going on, and yet the newbies of the market are willing to take the risk. They are willing to bet higher during the highs and even higher during the lows. So the new generation of India is no more as risk-averse as it was a decade ago. Today we have websites and softwares which give us timely reports of corporate ongoings. We can schedule and attend live meetings of the board. Besides, there are abundant free reviewing blogs and channels which give analysis reports to novice investors. The details related to numbers, statements, and financial ratios all are just a few clicks away. The investor of 21st century no more has to spend his time searching for data in heaps of paper. He no more has to spend hours calculating the PE or net book value of stock, which was once a privilege in itself. Sometimes this too much information is overwhelming and confusing, but it is much better than the past. However, by noting all the positives about this century, I don't mean to emphasize that the investing process or the process of generating returns has become easier. Investing is still as tiring as it was a decade ago. Returns are as hard to generate as they were a decade ago. Access to information doesn't guarantee success, but at least we can say that the gap between the institutions and the retail investors has reduced, and we can say that in a way, today they are on equal footing. Lastly, as it always has been, your work and dedication alone shall determine how you use your resources and where it takes you. But there is always an opportunity which lies hidden in every adversity. To be successful investors, we have to take the right steps at the right time. Let us now move on with our new definition of multibaggers. I would rather call this as reconceptualization than calling it as redefinition. According to my proposal, any stock which helps you generate returns greater than 50%, be it in a week or year, should be termed as multibagger. By this definition then, every stock trading on the bourses become a potential multibagger. Almost all stocks in their lifetime have all given returns greater than 50%. If you go through the chart, the lifetime stock chart of any great company or a failed company, you will see that at some phase it has given returns greater than 50%. Therefore, now your possibilities of finding a multibagger is not restricted to only stable or known companies, but to the worst of the worst stocks. According to our definition, all stocks have the potentiality of being a multibagger, but what matters now is the time of our entry and that of our exit. Verily, the way I am proposing might seem risky and in a way appear as if I am encouraging you to trade rather than our previous old wisdom of buy and hold. But such shall not be the case in actuality. As we shall move ahead in our chapters, one may realize that it won't be our choice to trade or hold, but the circumstance and its demand which shall be the decision maker. So far, you just stick to our definition and understand that all stocks have the potential to be a multibagger, and we can take their benefit if we learn to recognize them, which of course I'll be teaching you in this book. Chapter 3. Limitations of Numbers. Quote, "Interest is a reward for delayed gratification. The prudent earns it while the negligent pays it." Unquote, by Kalpesh Suryavanshi. Why use the method prescribed in this book instead of going by the methods of numbers, financials, and formulas? Surely I'm telling you to use common sense, but that doesn't mean that you stop using your higher sense, your intellect. We, in today's world, have robo-advisors and algos which have the capacity to manage and execute our trades on our behalf, that too with least or zero human intervention. The reason for all this possibility is nothing but the power of numbers. Our computers are masters when it comes to crunching those numbers and are almost flawless when it is about taking decisions based on numbers. So in a way, they too have a potential of being great investors, and perhaps one day we might have a successful AI investor/trader. But all this has limitations, and the reason is the numbers itself. Market, as we see today, is still a game dominated by emotions. Stocks today still reflect the emotions of traders in their volatility. A pandemic is about to occur or has occurred. CEO has committed suicide. The renowned flight of that company has crashed, etc. are the emotional situations which the computer cannot perceive. These are anticipatory situations which significantly impact the movement of stocks daily. Every week there is a new multibagger. a multibagger, which be so due to the above reasons. And this is why we still need humans to run our investment world, since we can anticipate certain events based on emotions alone. It is not machines that are profit oriented, but us. And so it is our duty to be aware of the ongoings in our system. Global situations like earthquakes, elections, wars, tsunamis, etc. are things which cause a threat not instantaneously but later in the time, but our market cannot wait for the impact. It is a reacting mechanism. It acts today based on what will happen tomorrow. Therefore, when it comes to predicting and preparing for the future, numbers provide only a little help. And the limitation of machines in these matters can be understood as well as is justified. But we as men are not in that position. We can anticipate situations, we can predict outcomes not with numbers but with common sense alone. We can anticipate how market may react if BJP party comes in power instead of Congress. We can determine in a way the policies of RBI. We know what the country needs, what the economy expects, and this sense alone is enough to fetch us few multibaggers. Should we then ditch the formulas and valuation methods? Is common sense sufficient to get rich? I would say partly, as discussed earlier. The strength of numbers alone is not sufficient, and so does the dependency on common sense alone. As we shall progress further in chapters, you will realize the importance of both logic as well as emotions. As far as the formulas or valuation models or softwares are concerned, they too are necessary, but only to some extent. Sometimes we may get deals which are called as value deals, and also deals which are referred as expensive, but both in a way are going to be profitable, and only reason for this is going to be our timing. The whole gist of this book is based on timing. How to recognize the right time to enter and the time to exit is all what we need, which may certainly sound easier on paper but much difficult in practice. But always remember that more practice and more experience you gain, easier will it get for you to apply the principles of this book. Take an example. India's biggest wealth destroyers, Reliance Communications and Videocon Industries, both were also one of the greatest wealth creators. Both of the stocks had given exceptional returns to their investors in just few years of their launch before their debacle in 2007-8 crisis. Currently, they both trade at their lifetime lows, struggling for volume as penny stocks. Should we then stop referring them as multibaggers? If we consider the time frame, then we can say that they both had their heydays and now are going through their mayday, but that doesn't undermine their previous height. For those who failed to book profits and got swayed away during the crisis have been so because of their own fault. RCom as well as Videocon, both as all companies struggled, survived, peaked and are struggling again. That is how the lifetime of most businesses is. That's how they start and that's how they all end. Even the too big to fail companies do fail. You have numerous examples of the past. Sony, Nokia, Xerox, IBM are some to name a few. Their products which go out of line, plans which turn into disasters, decisions which cause the debacle, all these things are not often the games of numbers but emotions. Nokia's tie-up with Microsoft was a decision they still are regretting. One with some sense of future could clearly see the outcome and get out by selling his stock before the numbers even enter the scenario. So, a sense of ongoing could save you a lot of time, trouble, and money. This sense is valuable, which machines don't possess. Neither are there numbers to see of it, but we as humans have the sense. We can polish it with experience and make it sharper. So in our next chapter, we shall start with our first classification of multibaggers, but before we reach there, I need you to note a few things. Number 1, take a pen and paper to note important points which are yet to come. Number 2, go through the examples as soon as you read them. Number 3, try to put your own thoughts on each upcoming topic and find similar examples relating to it. Number 4, discuss the topic with your friends, which will help you to grasp them better with the effort of memorizing them. Number 5, lastly, don't forget to submit an honest review about this book on Amazon or Flipkart, whichever site you buy from.
Chapter 4. Bye-bye examples. Quote, "It is easy to teach those who know nothing, difficult to teach those who know something, and almost impossible to teach those who think they know everything." Unquote, by Kalpesh Suryavanshi. This is not a dedicated chapter but a prequel, some essentials before we dive into our real work. Without the mention of this chapter, our work and our study about the subject shall remain incomplete. You might have known that learning with the help of examples becomes easier. Complex stuff can be simplified with examples and metaphors, which is why we often see the wide use of examples in every field of study. The mention of examples which are live and demonstrable also adds up as a proof to the conceptualized theory. But there are also certain drawbacks of giving examples. And to explain the drawbacks of example, I shall still use an example which is ironic in itself. Suppose you, as you are, were blind from your birth and you had no idea of colors and how objects around you look like. Then, by a chance of luck, you get a donor and your sight is replaced and you start seeing things. Now, for some reason, you ask me how red color looks like, and I use the tomato in front of you, showing that the way tomato looks like is what the color of red. So you fit that definition in your mind and start calling all shades of tomato red. Some tomatoes are orange, some yellowish, some greenish, but overall they all have a hint of red, and so every shade of red, despite minute differences, is still red to you. This is what I called the drawback of examples. Examples make you think according to a framework. They restrict your thinking into a particular model, and when you come across things which don't fit that model of yours, you then discard it, thinking it as useless. This way, your vision of knowledge too gets confined within a boundary, and anything outside it becomes alien to you. This kind of alienation and unfamiliarity causes you to leave many significant and important things which perhaps could change your life. Our natural instinct is to search for patterns. We try to find sense even in the nonsense, which is how we see things. That is how we perceive the world around us. Yet, the same method cannot be used while investing. We certainly have categorized businesses in their models and various industries, but no two businesses are ever alike, even if they are in the same industry or following the same business model. No two banks, no two motor companies, no two IT firms are alike. They all have their own strengths as well as weaknesses, and so all businesses like us are all unique in their own ways. That doesn't mean that examples serve no purpose. They do, which is why I'm writing this book, giving you patterns on how to identify multibaggers. But it was also necessary to let you know the limitations of examples. I don't want you to pick up an example from my book and start finding a replica of it in the market. Cause if you do so, then you are destined to fail. In further chapters, I shall give examples and patterns to identify but not use them as ultimate ideals. Time changes, businesses changes. A multibagger today may not be the multibagger tomorrow. A rough business today might turn smooth tomorrow and vice versa. These are not the laws of physics which we are discussing, which you may expect to remain the same for centuries. Our discussion is of businesses which, just like you and me, are alive. They are born, they die, they succeed and fail. As far as the definitions I give you, the patterns I teach you shall all remain the same regardless of time. The patterns and definitions are like the nets which you use to catch the fish. In brackets, fish on the other hand will be the examples, bracket closed. Some nets can catch only one kind of fish, while some nets can catch all kinds of fish.
Also, don't worry if you don't understand this metaphor now. As we shall progress in our chapters ahead, this all should start making sense. Chapter 5, Evergreen Multibaggers. Quote, hard work is overrated, patience is underrated. Unquote, by Kalpesh Suryavanshi. There are trees that remain green all the seasons. There are forests that remain green all the year. There are things which don't lose their charm throughout their life. We call them evergreen. So, do we have companies and stocks which don't lose their might? Their profits, revenue, and their stock chart in the long run is always ascending higher, climbing and breaking records year by year. As discussed earlier, companies like us are born, survive, and die. Some have longer lifespans while some shorter, but all aim to achieve progress, which some do and some don't. There are certain industries which, by their origin, have longer lifespan and some business models which have comparatively stronger hold in the market. For example, industries like FMCG, IT, banks, etc. are some which have a longer duration of survival, while industries like telecom, internet, airline, etc. are ones which are very competitive and have cutthroat competition, which is generally harmful for the companies that fall in that category. Regardless of it, multi-baggers are everywhere because a great company has learned to survive in that situation and can very well capitalize on it. Talking of business models, overall B2C business models tend to have an edge over other models like B2B. Often B2C models are easier to scale, run, and also easier for investors to understand, which helps them to make an estimate about the future earnings as well as their risks. Therefore, our kind of evergreen multi-baggers can be found in one of these two areas or even both. Evergreen multi-baggers are the ones which you are typically taught to identify in your so-called investing courses, books, and lectures. These are the businesses which most great investors of today had invested in the early days. These are the businesses which have made our today's billionaires and perhaps shall keep making them. The profile of these businesses is such that they hold a competitive advantage over their peers. Some even have a monopoly or an exceptional product or service. All this gives them above average numbers in their statements, which then the management uses effectively to scale further, franchise, and expand. Their business is not confined to any rules of the market because they are actually the rule makers. They are the trendsetters. Having said all that, it should also be obvious by now that such businesses and their management are solely customer oriented and operate in a strong ethical business environment. Numerically, these businesses generally have a ROE greater than 15%. They also tend to have a stable balance sheet, some of which are often net debt-free. As far as their sales or revenue is concerned, it is normally better than their competitors, which might range from 15 to 30% or more growth per year, depending on their industry and area of operations. Also, most of the evergreen multi-bagger companies tend to pay regular dividends, but some often decide to reinvest and offer it to shareholders via other means. Warren Buffett's favorite Dairy Queen, Jeff Bezos' Amazon, Mukesh Ambani's Reliance, Rakesh Jhunjhunwala's Dream Stock Titan, and many of such companies which can be termed as evergreen multi-baggers. Our India's FMCG sector alone has many such evergreen multi-baggers that have survived for multiple decades, like that of Hindustan Unilever, ITC Limited, Gillette India, Dabur India, Colgate Palmolive, etc. In our IT industry, we have Infosys, L&T Tech, HCL, etc. In banking, we have HDFC, Axis and State Bank of India, in brackets, SBI alone is one of the successful PSUs of India. Here, it is evergreen compared with other PSUs, not with our private players, bracket closed. One might also say that this list more or less contains examples which are blue chip companies, and you're definitely right in noticing it, but it is not that they started like this. All of these had a humble beginning.
All of these started with zero, and today, since I'm giving you these examples in hindsight, they appear to be blue chips. As an investor who wants to earn by investing, who wants to stay in the game for a longer period of time, should focus on these kind of multibaggers. You don't have to buy them when they are big, but have to fish them while they are small. I have made it easier for you by stating the characteristics, patterns, and models. There is already a bunch of literature around on how to find these kinds of multibaggers. People generally, when they use the word multibagger, they often mean exactly this kind. This kind which keeps growing year by year. This kind which is relatively stable and safer. This kind which is suitable for all ages and for all people having a kind of risk appetite. Evergreen multibaggers are actually the easiest kind of multibaggers to find, but what is difficult is to stick with our choice and trust our gut instinct no matter what happens. It is like planting a mango tree. It won't start bearing fruits in a short time frame, but shall take years, and for that you need nothing but patience. Many people often regret selling these kind of stocks. They are too quick to get out and miss out the complete journey. Also, evergreens are easy to find and invest, since it is never too late to invest in these businesses. One thing should also be noted here, that by evergreen, it doesn't mean that these businesses won't ever perish. They will eventually. The problem is most people consider investing in stocks as a passive activity, which is not true at all. Unlike the bond market or real estate market, our stocks change prices daily. Our management changes yearly. We hire new staff. We let retire the old. We launch a new product line. We also abandon the previous line. So every day there is an update in the business which eventually changes its valuation. So no matter what business or stock you fall in love with, don't ever decide to marry it. Love your stocks, but don't marry them because divorce is quite expensive these days. Buy them and stay invested in these businesses as long as they are profitable, as long as they stick to their core business activity, as long as their market share is strong, as long as they have no significant competitor, as long as the management is sound, as long as they are paying their dues and taxes on time. But if anything above goes sideways, if anything seems wrong, if anything about the core business or the management has done fraud, you should know. It's time to get out. It's time to sell. You see, when there is a tsunami or an earthquake, it does not occur just in a moment. Even nature gives you signs, warnings, and time to escape from the disaster. So does the market. Our mighty evergreen businesses won't go bust in a day. If there is a crisis, a problem, then it too will show signs, at least one of the above I stated earlier. But if you fail to notice those signs and you fail to escape, then nobody except you is to be blamed for the mess you are in. Most common cause of the failure of evergreen businesses is either the rise of a new significant competitor, debt, or change in the core of business activity. Look what Amazon has done to the brick and mortar retailers in America. Look what Jio has done to Idea and Vodafone. Look what Zerodha has done to the full-time brokers. All these are new age business strategies which have caused an end to an era of decade-old businesses, the evergreen businesses as they were once. So of course every business today or tomorrow shall fade and lose its charm, but if you are lucky and smart enough to grab it when it is still young and has potential to expand, then you are definitely on your way to wealth. D-Mart today is one of this kind. It is a young evergreen multibagger. They still have only less than 250 stores all over India. Can they scale it up higher? Sure, the growth potential for D-Mart in India is limitless. Why not 500 stores? Why not 5,000? More than 50% of population in India still lives in rural areas which depend on brick and mortar retailers for essentials as well as non-essentials. We have only a handful of metros, but hundreds of small towns and cities where D-Mart has the potential to make a presence. D-Mart on their business front has all what they need: a smart and shrewd founder, a strong management, top-class balance sheet, and abundance of capital, plus a proven and lasting business model.
They too will have some hiccups and potholes in their journey, but that alone is a test. Test whether it truly is one of the kind we think it to be. Reliance and Amazon, as stated earlier, both corporations have destroyed numerous industries and businesses with their presence and have now entered the area of DMart. Amazon, with its online presence, Prime Plans, is trying to provide one-day delivery to its customers, while Reliance, with its retail subsidiary too, has launched an e-commerce platform which is a direct threat to our young and potential evergreen multibagger DMart. Since I'm writing this book in the middle of their battle, and that too in the middle of this pandemic, which has caused great volatility in the market, it has become difficult to accurately predict the case of DMart. But if DMart succeeds in outshining its competitors and stands tall, securing its spot as a friendly nearby discount retail store, then the result shall continue as predicted. Our DMart shall one day be the blue chip of tomorrow, stable and relatively safe. Now then, we have 3 stages of multibagging, the evergreens. Stage 1, get in, enter with an expectation, a story or at least a direction. Know why you are entering that investment vehicle and where it should take you. Stage 2, stay. Be invested as long as things go on according to what you have planned, as long as your expectations match with the reality. Stage 3, get out. Sell when anything seems fishy, anything that seems to risk your principal and your future, anything that is a shock or an unplanned event which shall cause permanent damage to your company. In our example of DMart, which we assume to be an evergreen multibagger, we have thought well about all 3 stages. Stage 1. In case DMart is the expectation, it is the possibility that it can easily scale up to 5,000 stores, at least in the upcoming future, all over India. If such becomes possible, then the stock of DMart still has a potential to give 5-bagger return in the near future. Stage 2 is the stage where we are now at, the testing phase where it has to prove itself by outshining its competitors. Stage 3 then would be the case of failure. If DMart fails to meet our targets, expectations and to beat the competition, then we can expect its dream run to end. Now that you know the definition of evergreens, their kind or their pattern, and by being equipped with your knowledge about the 3 stages of multibagging, I expect you to now search on for more similar stocks or companies. Mind you, it won't be easy due to the fact that such knowledge takes time to reward you, and such ain't of any help if you're inexperienced. You should be well versed with the history of these businesses, which you ought to inspect, and along with it, you should have an understanding of the future, not limited to the company and its peers, but also extended to the whole industry in which it is operating. There is a reason why Warren Buffett still reads more than 500 pages a week. Every investor who wants to have evergreen multibaggers in his portfolio should have this quality of supervision. Read not only to find new picks, but to supervise your existing ones. You should know all about the corporate ongoings, company policies, management changes, product launches, competitors, and so on. In a way, these kinds of multibaggers are also most exhausting mentally, but also rewarding financially. It is easy to find them, but tiring to supervise them, as sometimes they might take up a great part of your life in reading stuff which perhaps you won't enjoy. But again, you have to like what you do or start doing what you like, since there is no other option. If you find all this act to be boring and joyless, then perhaps evergreen multibaggers are not for you. If you can't sit and hold without panic, then perhaps long-term investing isn't your cup of tea. So if you want to be rich and successful, you either learn and stick to evergreen multibaggers, because that's how most wealth is made till date. But if this seems too much, don't worry, for we have many chapters on multibaggers yet to come. The right kind, the right method will eventually strike you, and sooner or later you'll know what exactly you need and can do.